Welcome back. Now, gold glistened in 2007 for the seventh consecutive year, and it's ending this year above $800 an ounce, about $837 right now. Underpinning the rallies, perhaps, fears of rising inflation, now fed by increasing injections of liquidity by the world's central banks, including the U.S. Federal Reserve as well as the European Central Bank. With more injections of liquidity expected, as well as perhaps more rate cuts, the future for the precious metal looks bright. That's according to our next guest. He is Chip Hanlon. He is president of Delta Global Advisors. Chip, welcome.
Thanks for having me, Pim.
Chip, so can you give us the thesis for why you think gold prices will continue to increase? Are we going to see gold at $900, $1,000? Is it really just all tied to inflation and the U.S. dollar?
Well, yeah, I mean, at Delta Global Advisors, our investment policy committee just wrapped up a couple of weeks ago our projections for '08, including our outlook for gold prices. And we have an average price objective of about $850 an ounce for the year and reaching potentially a high of $925. And already we're looking at each other and thinking that we might be a little conservative in our projections. And with regards to the cause, yes, I think the path of central banks around the world seems pretty clear. We've already had a number of rate cuts from the Fed. We're likely to get more. The Central Bank of Canada has cut rates. The Bank of England has cut rates. The ECB is likely to join in, and we're seeing all these liquidity injections. So sure, when you see increased liquidity, you get more paper dollars chasing the same finite real goods, and it happens to drive up prices. So it's the environment we've been living in the last few years. We don't see much reason why that should change.
But Chip, let me ask you, I mean, if indeed rates continue to fall, wouldn't that cause more people to borrow, more companies to borrow, go into the debt market? We've heard, for example, that many financial companies in 2008 will be going into the debt market to raise additional money. Wouldn't that spur economic activity, increase the demand for money, and therefore gold as an asset that does not produce any yield, how would that be good for investors?
Interesting. Well, a couple of different things. That is the Fed's hope, that increased demand for money by lowering interest rates is going to bring about increased economic activity and economic growth. Economic growth covers a lot of warts by increased employment, increased tax revenues, et cetera. And so, I think we're facing a similar playbook to what we saw in the aftermath of the dot-com bubble and 9/11, where the Fed cut interest rates aggressively, hoping to spur economic activity of some kind. They did. They happened to spur a new bubble, one in real estate. So as this one blows up, they're going to revert to the same old playbook, increasing liquidity, and hope that they can generate enough economic activity elsewhere in the economy to offset the weakness in real estate and the financial sector. I do agree with you that eventually financial stocks are going to be an outstanding buy. I just don't think they've gone through their full turmoil yet, and there's one more shoe left to drop, even on the real estate side, and that's corporate real estate. We're starting to see the early signs that prices are going to come down there based on tighter and more expensive credit. So I think the real estate story is going to be, in 2008, is going to have to do with falling corporate real estate and pain in that side. And so perhaps 6, 12, 18 months out, there's going to be a fabulous buy in real estate and financials, but not yet. We're not through this unwinding process, regardless of what the Fed does.
I see. Okay, so you're looking at what's also happening in the commercial real estate market. Chip, let me ask you, when you talk about commercial real estate, we talk about building, construction, not only in the United States, but what about some of the industrial metals, perhaps copper? Are we going to see demand for copper continue to increase prices?
That's a very interesting question, and the offsetting answer is, I suspect, yes. That sounds a bit strange, but it's important to note at this point that, we are not amongst the perma bears or the gold bugs that I like to refer to sometimes as the economic ayatollahs, because they always seem to be shouting death to America, at least financially speaking, right? We take a balanced look at things, and while we think the underlying fundamentals are supportive of gold in terms of increased liquidity, and we are worried about the impacts of this real estate bubble, we're not convinced that recession, should it occur, is going to be deep or too severe because of the aggressive actions of central banks. They're going to take every action that they can to prop up the economy via liquidity, via lower interest rates. That environment is one that is tremendously supportive of commodities across the board, including even the industrial metals. One other point on the industrial metals, there's been enormous news in the last week that's gone largely unreported, and has to do with China's tariff policies for 2008. China, about across the board with regards to steel, agricultural commodities, energy, you name it, has slashed import tariffs while simultaneously meaningfully hiking export tariffs on all those goods. So they are firmly stating to the world that we need to do everything we can do to bring those natural resources within our borders and everything we can to keep them from leaving, because our demand for raw materials still continues apace. I wrote about this a little bit this morning over at greenfaucet.com, the investment website, and I'm a big believer that China is stating very clearly that they're going to continue to be a powerful demand-side support for industrial metals and raw materials of all kinds. So we remain bullish on that group.
All right, we're going to have to leave it there. Thank you very much, Chip Hanlon, president of Delta Global Advisors. We're coming right back.